Hey, Adine here, and thanks for joining me. Today I want to tell you a story about a guy who called me actually yesterday with a pretty random question, but I thought it was a great topic for me to discuss and kind of go over, as it is a strange situation. He and his wife went out and purchased a vehicle, and by any vehicle. They bought a plug-in electric vehicle, which some of you may know, some of you may not know. Plug-in electric vehicles, for the most part, are eligible for a tax credit up to $7,500. And if you notice, I put some emphasis on up to, because it's not guaranteed that you get the full $7,500. Now, the first stipulation is how many cars that this manufacturer sell. I'm going to take the most commonly known vehicle, and the Tesla, and talk about the Tesla. So the rule is that the $7,500 is available until a manufacturer sells 200,000 units cumulatively, not in a single year, but cumulatively. And if you were following Tesla, or if you by chance saw it in the news, Tesla hit that 200 in December of 2018. And for a second, everybody freaked out because it meant that that $7,500 credit was not going to be available forever. It was going to go down starting in the first quarter of 2019. So a lot of people said, hey, okay, if I'm going to buy a Tesla anytime soon, I'm going to go now, so I'm eligible for this $7,500 credit. And what's happened since then is, again, depending on if you follow Tesla, you might know this already, but Tesla's had to drop the price of their vehicles in order to make up for the fact that the tax credit has gone down from $7,500 to $3,750 and will keep going down until it goes to zero, because they've, based on the government, hit scale and are selling enough of them. Well, anyway, going back to this client that called me yesterday, they didn't buy a Tesla, they bought a Chevy Volt, similar deal. But their issue was that the $7,500 tax credit is what's called a non-refundable tax credit. And that's really what I want to talk about, is the difference between what a refundable tax credit is and what a non-refundable tax credit is, because it's very important. I've had a few instances during tax season where people have heard about different credits and they're excited, they're going to get a refund. However, if you have this thing over here, it's called a non-refundable tax credit. All it does is decreases your tax that you owe for the year before any other tax credits, before most any other adjustments. It'll decrease how much you owe in tax. And when I say other adjustments, what I'm really talking about is if you have a job, they take money out of your paycheck. So that part's ignored to compute how much of the non-refundable tax credit you're going to get. And then on the flip side, what happens is it takes your tax owed down to zero, but it will not go below zero to a point that you get a refund. And so for this couple that called me yesterday, they're actually retired. They draw on Social Security, and they have a little bit of other income coming in. So their taxable income is very, very little. As a result, their tax that they owed was very, very little. And they didn't pay anything in. So whatever that amount was that they owed is the only amount that they ended up getting a tax credit for buying the electric vehicle, because, again, that's a non-refundable credit. So it took the amount of money that they would have normally owed, took it to zero, and stopped there. The exact number for this couple is unfortunately only about $540 that they were able to get out of this credit. And now imagine their shock when they saw $540 versus $7,500. And if you're like most people, including myself, when you think about something like that and you go and you buy a $35,000, $40,000 car and you think, okay, $7,500 tax credit, this car is going to cost me $7,500 less, and then you only find out you got a $500 deal, you're a tad bit disappointed. So I'm going to talk a little bit about refundable credits and then talk a little bit about what this couple should have done and how it might help you in the future as you're making different choices, whether it's credit related or not. So on the other side, you have refundable tax credits. And one of the most commonly known is the child tax credit. And after the Trump tax changes, a lot more people are eligible for the child tax credit and have received it. And so, similar to the non-refundable tax credit, the child tax credit will first, or any sort of refundable tax credit will first decrease your tax owed. However, it allows you to go into tax owed negative, meaning refund territory. So let's say, and so this is really very prevalent with low income taxpayers. Around tax time, you'll see signs when you drive around saying, okay, one child you get X, you can get up to X dollars back, 2 children up to X, 3, whatever. It's because the child tax credit is refundable and you can get the excess returned to you. So with that, like let's say you make $15,000 a year, $20,000 a year, and you have one child, on that $20,000, your tax owed might be $800. Now that you have one child, the child tax credit is $2,000. So the first thing that happens is that $800 goes to zero. You don't owe any taxes. Plus, the additional $1,200 gets refunded to you. And so this is how people can get refunds without really having paid any tax. Everybody else who's at a higher income level or doesn't have kids or doesn't have any other refundable tax credits, you almost always either owe some money or you've paid some money through your paycheck, or you might have some sort of non-refundable tax credit that'll take you close to zero, but not to a refund status. All right, so now the big important lesson from this. Obviously, the different tax credits, but one of the things that came to mind with this couple is they had some really, really great planning opportunities that they completely missed. So they're DIYers, do-it-yourselfers. They didn't want to seek professional advice. They used TurboTax. They even called TurboTax to figure out about this credit, and the best TurboTax was able to do for them is tell them, hey, buy our more expensive package. It might help you then. Of course it didn't, because it doesn't matter how much you pay for the tax software. They would have been limited to that $540. What they should have done or could have done is created a higher tax liability. Now you're probably scratching your head going, why would I want to create a tax liability? It's simple, because you have the $7,500 credit that's going to go to waste if you don't. So now, okay, we're with that. How do we create this tax liability? The first thing that they could have done is they could have looked at all their assets that they have. And again, I didn't get into it because they're not a client of mine. They found me randomly. But if they have real estate that has appreciated, if they have stocks that have appreciated, any sort of other valuables that they could have sold and created a gain, well, now that gain would have caused tax, and they could have offset that tax with this credit. So effectively, they could have sold some assets at a gain and paid zero tax if they had done some planning. The other super cool thing that they could have done that they completely missed is a Roth conversion. As I mentioned at the beginning of the video, they're retired. And so they do have some money sitting in IRAs, and the gentleman's actually taken what are called required minimum distributions. I'm not going to get into that here. I'll do a separate video on that. But with the required minimum distributions, he was forced to take money out of the IRA and pay tax on them. What they could have done had they realized how this tax credit works is they could have converted IRA money that he's forced to take out and pay tax on. They could have converted that to a Roth IRA, which most of the time causes tax, because you're going from what's called a tax deferred IRA to a after tax IRA in the Roth. But again, they could have done this conversion tax free with some good planning had they realized that this credit is going to go to waste. So they could have created an additional $7,000 liability vis-a-vis a Roth conversion and paid zero on that conversion. And why is this important? One, Roth IRAs don't have required minimum distributions. So if they didn't need that money coming out of the IRA, they wouldn't be forced to take it out. So it would have saved them some tax dollars. Two, the longer that money sits in an IRA, the longer it can grow. It's going to be invested in the market. And three, again, depending on what sort of planning you do, if it's part of your estate plan, if you're thinking about leaving some money to your kids or grandkids, Roth IRAs function as a very cool vehicle that lets you do some really neat planning around it. And they failed across all three of these. And so they got hosed. They ended up paying an extra $7,000 for a vehicle because they didn't maximize this tax credit. And the moral of the story, I guess, is all they had to do at some point last year, September, October, November, say, we're thinking about buying an electric vehicle. What do we need to know? Does it make sense to go find a pro and, pay $300, $400, $500 for really good planning, and what they would have gotten out of it is $7,000. Unfortunately, there's nothing you can do retroactively. So I think it's a lesson for them, and hopefully none of you will make this mistake. Sometimes it's worth paying a little bit on the front end and getting better results on the back end than just going it yourself. I'm somebody who totally understands not wanting to pay a little bit in professional and consulting fees. However, there's many times that it's totally worth it and you get 10 to 20 times your money back. So if you have any questions, whether it's about credits or it's Roth conversions, IRAs, feel free to reach out to me and we'll work on it. All right, you guys take care.